The WeWork saga, not that surprisingly, continues now with the question of who's going to finance the company as SoftBank takes control. Sonali, Goldman Sachs set to the plate to get a loan deal done, but there is something very unique about this deal. Please explain.
Well, for the first thing is SoftBank is the one that is working with Goldman Sachs, with WeWork as the co-borrower here. And so remember, SoftBank and WeWork have become much more intertwined since they have gotten into this deal. But really, SoftBank is really emerging here as somebody that's still somebody that many of the banks still want to work with. Remember, despite all the troubles that have happened this year, they have a big portfolio company. Something to look out for next year, for example, is DoorDash, also a portfolio company in the Vision Fund, looking to potentially go public and has worked with JP Morgan for a $400 million credit facility here.
Yeah, although SoftBank is listed as the main borrower, and I found this fascinating because they're putting their own money and their own name on the block here. How much of a liability is this for SoftBank in a broader sense? I mean, is WeWork an isolated case of them bringing it into their purview, or are they going to bring other portfolio companies also in?
WeWork right now is definitely a one-off given how far it had fallen from its peak. And remember, it's as close as you can get to a subsidiary company of SoftBank. And so for now, it's a one-off. But if SoftBank is going to put that much of their own money at stake for somebody else, you do need to keep an eye out, I would say, on how close their other companies get to them.
All right, well, that brings me to Natalie, because we have been seeing Amazon in particular say that it was going to come to New York, then say forget about it for HQ2, but not really. Natalie, please explain. We're actually seeing Amazon come to the city as well as a whole number of other tech companies.
Right, it's a big change from just a few months ago when Amazon announced that it was no longer coming to Long Island City. Now they've announced a 335,000 square foot lease in Hudson Yards, which shows that they're really committing to growing in New York City, even after everything that's happened. And on top of that, we had Facebook and Google continue to expand in the city. Facebook just signed a lease for 1.5 million square feet in Hudson Yards. It's going to double its presence in New York City over the next decade.
Okay, can you put this into perspective, though? I mean, is this basically a tiny fraction of the overall office space and employment in New York City, or is this taking on a sort of Silicon Valley 2 feel?
It's starting to take off. I mean, for now, financial services industry still takes on majority of the real estate here. Right now, financial services industry takes up around 30% of currently occupied space, whereas TAMI tenants, tech, advertising, media, information, take up around 24%. So there's still a lot more room for tech tenants to catch up, but they're starting to catch on, especially with these big leases coming into play. It's only going to continue to grow.
Is there a particular area? Because I know that Long Island City was sort of the place for HQ2 that never transpired with a lot of political pushback.
Lots of the tech tenants right now are kind of huddled around the new Hudson Yards area, the Chelsea area. Some of them are looking around Midtown Manhattan. These are all places where we're seeing that they're starting to come more and more so into Manhattan for now. Some are still looking at Brooklyn a little bit, but I'm not too sure about Queens.
All right, well, let's get to some consolidation. And Lisa Lee has been following that. We're seeing consolidation in the loan business, which I find interesting. Could you just give us a lay of the land as far as what we're seeing?
Well, we just recently had First Eagle, which is an asset manager with about $100 billion in assets, purchased TSO Credit Advisors, which is a direct lender and CLO shop. And Goldman Sachs just merged two of its BDCs, which are closed-end funds that lend to middle-sized companies.
So, Lisa, what's the advantage of these firms merging?
It's definitely scale, especially in the direct lending platform. The money has come in so much into direct lending that you want to be bigger, be able to underwrite and to hold the loans that you found. And that's definitely THL and First Eagle's thought process. And for Goldman Sachs in the BDC space, it takes their BDC to $3.3 billion and gives them greater diversity.
All right, and going forward, do we expect this to be an ongoing trend of consolidation, or are we pretty much reaching a certain sort of stasis?
Well, definitely mergers beget other mergers, and you can see more, especially in the direct lending space. In the CLO spot, partly this might be one-off, but especially in the BDC space, experts see this as a ripe industry for consolidations. The problem is that among BDCs, the quirk of the fund makes pushing through and agitating an acquisition difficult, but there's definitely room for more.